program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.
Hello and welcome to the Global View on this Friday. I'm Andrew Geoghegan. Good to have you with us again here at Ausbiz. Let's get across what we have seen overnight. Global equity markets gaining further with investors preparing to take on more risk. This is despite the potential ramifications of a US government shutdown. However, shutdowns in the past have typically had a limited impact on the markets, with the S&P 500 finishing higher during every shutdown since 1995. On Wall Street overnight, the major indices made modest gains, but again closed at record highs, led largely by the tech sector. Well, that was thanks to gains in the likes of Nvidia, Apple and Broadcom. Tesla ended down though for its largest one-day loss since July. The EV maker giving up early gains after strong quarterly deliveries report, because some analysts flag risks to sales in the upcoming quarters, particularly due to the withdrawal of the $7,500 federal tax credit. Netflix shares fell for the fourth consecutive session after Elon Musk called for X users to cancel their subscriptions to the streaming platform due to a show that critics say promotes transgenderism to children. Shares of credit bureaus Equifax and TransUnion fell heavily after FICO launched a program that could allow mortgage lenders to gain access to credit scores without relying on those bureaus, and FICO shares surging at the same time. Occidental Petroleum said it would sell its petrochemical division to Warren Buffett's Berkshire Hathaway for $9.7 billion, sending its shares down, whereas Berkshire gaining some 8%. Well, the US shutdown is impacting most government operations and has led to the temporary layoff of hundreds of thousands of workers, while President Trump says he's taking the opportunity to permanently dismiss as many as 300,000 workers by December. Job layoffs in the year to September total 946,000, the highest since 2020. And the release of the non-farm payrolls report delayed by the shutdown, the Federal Reserve Bank of Chicago estimating September jobless rate came in at 4.3%. FOMC member Austin Goolsbee saying the labour market remains stable, saying I think it indicates that some steadiness in the labour market, and I think that the underlying economy is still growing pretty solidly. While Larry Logan has said, I'm seeing that inflation is running above our 2% current target. Meanwhile, Treasury Secretary Scott Bessent plans to complete the first round of interviews for the Fed chair next week and expects to send 3 of 5 names to President Trump for consideration. Well, the US 2-year Treasury a little changed at 3.57%, the 10-year falling to 4.08%. And the US dollar index up slightly on the day. The euro fell after data showed the Eurozone unemployment rate in August rose to 6.3%. The Aussie dollar has fallen back to 66 US cents. Oil prices have fallen to their lowest level in 4 months as concern mounts over oversupply the market ahead of a meeting of OPEC Plus group this weekend. Brent crude futures down 2% at $64 a barrel. Copper rose 1.3%, reaching its highest in more than a year. Iron ore little changed, $103 a tonne, and gold prices have retreated from a record, with spot gold at around $3,850 an ounce. And Bitcoin rising to 120,000 US dollars. Let's get more on what we're seeing on the US equity market. Dave Sekera is the Chief US Market Strategist at Morningstar. He joins us again now. Dave, welcome back. Good to catch up as we do monthly with you, rounding out where we've been for the past quarter, of course. How would you sum it up? I mean, just take a look at that last session gone. Records again.
Yeah, now another strong quarter here in the U.S. The Morningstar US Market Index was up just slightly over 8%. So year to date, we're now up about 14.5%, but it's still all about artificial intelligence, all about the build out and the deployment. So we're still seeing a very concentrated market here in the U.S. If we do a quick attribution analysis, I would just note only 6 companies account for about 60% of the market return in the third quarter. When we break that down, Apple accounted for about 16% of the market return. It was up 24% just in the third quarter. Alphabet, that was up 38%. That's 16% of the market return. Nvidia up 18%. That's 14% of the market return. Just going down the numbers here, Tesla was up 40%, Broadcom up 20%, Oracle, Palantir both up a lot. So again, a lot of it is still all about AI, the build out and what we're seeing going on there. I would just note that looking forward, when I look at a lot of these same stocks, we're just not seeing any margin of safety. When I think about, my fourth quarter outlook, the title for that is going to be, no room or no margin for error. Alphabet, Nvidia, Broadcom, Oracle are all rated 3-star stocks, essentially meaning they trade within a range we consider to be fairly valued. Both Apple and Palantir are 2-star rated stocks. We think those are both overvalued. And you were just talking about Tesla earlier. Again, Tesla is a stock that we've covered for a long time through thick and thin. There's been times it's been a 4 and 5-star rated stock, but we think the market's getting ahead of itself on that one. It's now a 1-star rated stock.
Dave, do you feel as though perhaps the market is on the precipice, or this bull run has more to run? I see you note that real economy stocks are providing something of a warning.
Yeah, and so I think we're seeing, the bifurcation in the U.S. in the economy. So the real economy, is definitely still slowing. In fact, when we look at our U.S. economic outlook, we're expecting the next 4 quarters to see sequential slowing in the rate of growth of GDP. AI with its build out has been able to essentially cover up a lot of the weakness that we've seen elsewhere. But when I'm looking at some of the returns, this past quarter, some of the earnings estimates that are out there, I just note like the commodity chemical companies, of course, they're making the precursors for the chemicals that are used across the entire economy. They've already been hit pretty hard this year. Some of these companies were reporting EBITDA down 50% year over year. I mean, that was just an eye opener to me. Some of these companies like Celanese, Eastman, Dow are down 15 to 28% over the past quarter. Transports don't seem to be doing much better. A lot of these trucking companies, Old Dominion, Landstar, Knight Swift, I mean, they're down 11 to 13%. And then looking at the industrial sector, a lot of these are down double-digit percentages. Honeywell, Carrier, Allison Transmission, Lennox, the list goes on. And then a lot of the high flyers that we've been cautioning, over the course of the past quarter or two that, had just gotten to be way too far into overvalued territory. We are seeing, some of those starting to correct, especially in a lot of the consumer names like Chipotle and Wingstop. Those were down about 30% on average. So we're definitely seeing a lot of, ripples underneath the surface that, not all is well as in the economy. We're not looking for a recession, but for the next 4 quarters, expect growth to slow. And so it really all just continues to be, how much longer and how much more will this build out continue in artificial intelligence?
Well, what are you, taking a look at the sectors there, what are your picks at the moment, Dave?
Well, I mean, after the rally we've had thus far this year, there's only 3 sectors that we still consider to be undervalued today. That's going to be the real estate sector, the energy sector, and the healthcare sector. Each of these to some degree have some idiosyncratic issues. Now, real estate, I expect that should benefit from easing monetary policy as the Fed cuts rates. We also expect long-term interest rates to come down. So I see a lot of the benefits that should be coming through in real estate. Personally, I'd probably still steer clear of urban office space. But a lot of those tenants that have more defensive characteristics we find to be very attractive in this market. A lot of people are still hating on energy. Oil prices certainly have been somewhat bearish here in the short term. I think the market is probably too bearish on oil over the longer term. So we see a lot of opportunities there, whether it's Exxon among the global majors or Devon here in the U.S. And then lastly, healthcare, and especially the healthcare names here in the U.S. The market's been very concerned about potential changes in regulation, changes in reimbursement rates by the U.S. government. So that sector's been under a lot of pressure and has lagged the broad market rally thus far this year.
Individually, stock-wise, Dave, what are you looking at the moment?
It is so hard finding undervalued stocks to recommend today. I mean, when I look at our overall coverage, we cover well over 700 stocks that trade on U.S. exchanges. At this point, I think less than 35% of our coverage is rated 4 or 5 stars, so those that we think are attractive. And in fact, it's almost a barbell. About 35% of our coverage is now rated 1 or 2 stars, meaning that we think that they're overvalued. So it is very difficult trying to find undervalued stories. What we see is undervalued, typically is undervalued for a reason. They're usually more a bit of a story stock. So you do have to go out on a limb a little bit, try and find where we have a differentiated view from the market. Now, I was just mentioning that in the real estate sector, personally I'd steer clear of urban office space, but That is some of the area that we do have a bit of a differentiated opinion. If you look at Empire State Realty Trust, that's a Manhattan-focused REIT for office space. It's a 4-star rated stock, trades at about a 20% discount to our fair value. Stock is down about 26% thus far this year. We've held our fair value steady. Looks, as far as a value play, pretty attractive. Only trades at 9 times, Fed's from operations. And if you look at New York City specifically, the amount of office space that's available for subleasing has come down, pretty substantially. It's only at 16.8 million square feet, was, 22.6 million square feet last year. We are seeing, office lease rents increase by 12%. So if you are going to play in the real estate space and you are looking for that urban office exposure, that would be the one that I would highlight.
What about those sell? We actually flashed that up, Reddit. Why have you got that on your sell list?
I'm sorry, you're breaking up a little bit. Which one?
Reddit, I see, is on your sell list.
Yeah. Yeah, now it's interesting. If you look at Reddit, that was trading at a huge premium, earlier this year. It's still, even after being down 25% from its peak, still a 1-star rated stock. We think it still has a lot further to fall. Some of the more recent sell-off is just that a few of the AI platforms have announced that they're no longer going to use Reddit for training their large language models. So that's put pressure under the stock. And I'd also note, too, I think a lot of advertisers are going to put a lot of scrutiny on whether or not they're going to want to be associated with the Reddit brand. That was a platform that was highlighted here in the media. The person that was accused of assassinating Charlie Kirk was using Reddit beforehand. So I think advertisers are going to think twice about using that platform. And even with a 5-year compound annual growth rate of revenue of 33% in our model, we're looking at earnings of $1.67 this year, growing all the way to $4.75 by 2029. Even if we're correct in our model, the still trading at like 55 times 2029 earnings, so way too expensive in our view.
Dave, terrific as you get across what you're seeing on the US market. Thanks for joining us in Morningstar.
Well, thank you.
Let's now return to the local market. Ahead of the open in just a couple of minutes' time, we are expecting a marginally negative open. Let's call it flat, shall we? We'll see what develops when we get going in just a minute or two. Stay with us.
This program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.